Hello and welcome to our next session. Here we're going to look at the December 14 multiple choice questions for the F7 paper. We'll look in this session at questions 1 to 5. So what we're doing here is we're both learning from the correct answers but also from the incorrect answers, because often in future questions very similar answers will come up, particularly for the discussion type ones where they're just select the correct answer. For the other calculation questions, we're simply looking at the quickest, most efficient way to do the calculations. So the best way to do these is that we'll initially look at the question, then you need to stop, have a go at it, see what you get, and then work through the answer with me. And we do that step by step. So let's start with question 1. Read through these. We're looking for changes in accounting estimates and errors and policies. And this one particularly is asking you which is an accounting policy change. So have a go, see if you can select the correct one, and then work through the answer with me. Okay, so remember, a change in accounting policy will be a change in the recognition, measurement, or presentation of something. If it's not that, well then it's a change in estimate. So let's go through these and see which is a change in accounting policies. So A, classifying commission earned as revenue in statement of profit and loss, having previously classified it as other operating income. Now, we don't have to go too far here because that is a change in the classification of something. So presentation will have changed there, and that is a change in policy. So we've changed the presentation of revenue from profit and loss to other income, so that is a change in policy. Let's just confirm why the other ones aren't. So for B, that's not a change in policy, because switching to purchasing plant using finance leases, having previously used cash, isn't a change in accounting at all. It's just a change in company strategy. C, changing the value of subsidiaries inventory in line with group policy. Well, that's making an adjustment to bring it into the group. It's not a change in the actual policy for that subsidiary's accounts. So change made to prepare the group accounts. And D, revising the useful economic life. Well, that's a change in estimate. That's judgment made by the accountant. So the answer was A. Remember, look for a change in recognition, presentation, or measurement. That will be your change in policy. And in this one, it was a change in presentation. Okay, moving on to question 2. Have a look, read through it carefully, select your answer, and then work through it with me. Okay, so this question surrounds earnings per share. They've done the basic one correctly, and now they're going to do their diluted. Which of these will affect it? Well, this just tests whether you know what the calculation for diluted earnings per share involves. So looking at each of these in turn, a 1 for 5 rights issue, don't need to read any more because a rights issue will affect the basic earnings per share, not diluted. So they've already dealt with that. 2, the issue of convertible loan notes. Yes, that will affect diluted earnings per share because we'll need to bring in the possible conversion of those into shares. So that will affect it. Granting of share options. Yes, that's the other thing that will affect diluted earnings per share. So we know that 4 mustn't be right then. And it's equity shares issued during the year for a new subsidiary. Well, again, those have actually been issued, so those will be included in the basic earnings per share. So that won't affect diluted earnings per share. So the ones we were looking for were 2 and 3, which is answer C. And you should have been able to do that if you knew your calculation for diluted earnings per share. Moving on then to question 3. Have a read through it, make sure you understand exactly what they're talking about, and then select your answer. Okay, so our calculation here is going to be working it out under historical cost, so the carrying value under historical cost and under current cost. So historical cost, well, we start off with a value of 500,000. We've got an estimated residual value of 10%, so we need to multiply it by 90% to get the total amount to be depreciated. And we're doing that over 5 years, so that's 90,000. So looking at the dates, that means we've had 2 years of depreciation at 90,000 to leave us with 320. So we now know that we have either A or B as our correct answer here. Now, looking to current cost. Well, current cost will still have depreciation. So we have a current cost 600,000. We're told that in the question. But we still need to bring in the annual depreciation. And we do that over 2 years to give us 384,000. So 108,000 each year for 2 years, 384. And that means that we were looking for answer B. So it was tempting to go for A and not bring in the depreciation. Just make sure that you depreciate it also under both methods. Okay, so answer 4 then. Let's have a look. See if you can read through these. You've got 4 selections. Be careful when reading through exactly what is happening. Select your answer and then work through it with me. Okay, so taking these each in turn. Which of these has been correctly included in revenue according to IAS 18 revenue? Now moving forward, this will be IFRS 15 for revenue, but it wouldn't actually change the treatment. So this would equally be okay for the future. So agency sales, will look, only commission should be included on agency sales. So they shouldn't include the 250. B, sale proceeds for motor vehicles no longer required. Well, look, that's not going to be included in revenue. That will go into a disposal account for them to work out the profit or loss on the sale. C, sales of 150,000, invoiced and received from the customer 180, which includes 30,000 for ongoing servicing work. Now, that, although the invoiced amount is 180, 30,000 has not yet been earned and is deferred until the servicing work has been completed. So they've recognised the 150 correctly. The 30 will then be recognised over the next 2 years. So that looks correct. Let's just check D. Well, sales of 200,000, they're not though going to pay for a while with a cost of capital of 10%. So the payment isn't going to happen for 2 years, in fact. Those should be discounted and they're not. So they wouldn't bring in the 200,000, they'd need to discount it. So yes, C looked correct, and indeed that is the correct answer. Lastly then for this session, question 5. Look at these potential liabilities and decide which of them should be recognised. See if you can remember the criteria for liabilities as you do it. Select your correct answer and then we'll work through it together. Okay, so starting with number 1, we're looking for things that should be recognised as liabilities. So the signing of a non-cancelable contract to supply goods in the following year, which due to a pricing error, they'll make a loss on. Well, that is an example of an onerous contract. We specifically mentioned those, and you will be able to create a liability for them. That's because, and remember the criteria for a liability, it needs to be a legal or constructive obligation, and this is a legal obligation. It also needs to be probable, and we need to have a reliable measure. But this one was focusing in on the obligation, and this was one. So yes, we'll create a liability for that. Cost of reorganisation, approved by the board, not yet implemented or communicated to interested parties or announced publicly. Well, look, we learnt that you can only recognise a provision for a reorganisation if you've done both, as in you've got a plan and you've announced it. So in this instance, it hasn't been announced. It would need to be announced to create a liability. Number 3, deferred tax relating to the gain on the revaluation of a property during the current year. Well, that seems right so far. Remember, if we revalue a property, that will increase its value, but the tax base will remain the same. So that will create deferred tax. And they've no intention of selling the property. Well, that doesn't matter. It still creates a deferred tax liability. So that would create a deferred tax liability. And 4, the balance on warranty provisions, no outstanding claims, and they've expired, so no obligation there, so that wouldn't create a liability. So that means that we have 1 and 3, which is answer C. Make sure that you know which of these will create liabilities. This is quite an important question because it gives good examples of lots of different areas they could ask on liabilities: an onerous contract, a provision for reorganisation, deferred tax, warranty provisions, all key areas that you should know.